about advanced scalping strategies. I know this was a popular one when we were talking about scalping strategies last time. So as always, I'm Thomas Atkinson. I'm joined with Tyrone this week. He's here.
Hi everyone, and welcome to Advanced Scalping Strategies. This is a good way to trade and a good fun way to learn the markets if you're just beginning, and a really good way to hone your skills in if you're actually a little bit more advanced. So it should be a good night.
Yeah, we've got some good examples. If anyone was here a little bit earlier, you might have seen me on the charts, just having a quick look at a few things. So we'll be going through some live examples tonight. We'll probably be really on the charts as much as possible and less in the slides because we've got some feedback, and I think that's what a lot of people like. So as always, let's get started by going through the risk warning. The information provided here is being produced by third parties and does not reflect the opinion of Pepperstone. The information has been provided without any alteration or verification. So as always, just grab a quick read of that and we'll go into the next bit. So what we're going to be covering today, we're going to be taking a look at what time frame scalping strategies best work on. And we're also going to be taking a look at building a scalping system on a points-based approach. So we're not going to just look at one type of scalping strategy. We might look at a few different ones. In particular, we're looking at break strategies within trends because they can be quite successful on the smaller timeframes. And we're going to be coming and using a little bit of some of the stuff from multi-time frame analysis that we did last week. So if anyone missed that, I really recommend go watch that one. It's just me talking stuff, but I did go through multi-time frame, and it's really essential that when you're scalping, you paint a picture of what's happening in the market. If you're just looking at one time frame, you may not have the success that you should with your systems. So always look at multi-time frames. We'll also be going to cover what market conditions we are looking for before using a scalping strategy, and as always, a Q&A which we'll answer at the end. So if you have questions, please ask them. Fabian and the other moderators will grab some of the best questions and we'll answer them at the end. Tyrone, anything else?
Perfect. Yeah. Now, look, when we're going to work through the advanced scalping strategies, you're probably wondering why we're using multi-time frame to really back up what we're trying to say. We will go and explain it through thoroughly, but there are a couple of really good examples tonight where using the multi-time frame analysis makes the scalping so much stronger. So really looking forward to seeing that. So if you're wondering why we're using multi-time frame, it's just to really solidify the movement of what we're trying to scalp.
Remember, we want to be trading where the big boys are trading. We don't want to be trading on the 5-minute, 1 minute, ideally, even with scalping. If we can be trading the 15-minute, 30-minute, 1 hour, that's a good session because we can do that within a London session. If we're trading 3 to 4 hours a night or 2 hours even in an open period, you will see a lot of these breaks occurring. You will get the opportunities on those charts. So always try to go 15-minute minimum if possible. We're never scalping. So we talked about this one last week. It's called the top-down approach. We always start with the highest time frame we're looking at, and then we work down. So if we're looking at a 15-minute, maybe we'll start with a 4-hour, figure out a little bit about what's going on in the 4-hour, jump into the 1 hour, and then go down to the 15-minute and make our trade decisions on that 15-minute. We'll also need to recognize whether the market's trending or range bound. We'll give you a few techniques tonight on how to do that, and use line, bar, and candle analysis. Don't fall in the trap of just using candles or bars. We've got a really good example of something like that tonight as well on the US dollar yen. So bring that one up and do it with us later.
So if you've been to a lot of our webinars, you're going to hear us talking about the trading system rules. Tonight is no exception. Scalping strategies still have a lot of rules that you've got to follow. And if you do, your scalping is going to be a lot better. So we're going to talk about some of the rules that we will follow whenever we're looking at any scalping, including the different time frames. And of course, your ability to manage trades. So basically,
yeah, you are your own worst enemy, unfortunately.
You can be your own worst enemy. So yeah, managing your trades is a really, really important part. And especially when people have got a scalping mindset, you do find that you'll trade probably more often than you normally would if you were actually looking for a longer term strategy. And by that, I mean, scalpers spend a lot of time in front of the screen and they want to justify the time investment by placing trades. Not always necessarily the best strategy.
Don't do the 50 pips a week is all I need. Please don't do that.
No, the market will give you what the market will give you. There's no set number. So yeah, we'll have a little bit of a talk about that as well.
Yeah, we'll cover that a little bit later. Okay, so just a slide from last week. Just wanted to select timeframes. How do things look? A few people out there correctly identified this last week. This is a shooting star candle on the 4-hour, but you can see how things look a little bit different. By going up to that bigger time frame, we can actually get a lot more conviction of what the market is doing. We can say, okay, this is a 4-hour shooting star. There could be some pretty big bearish pressure coming after this candle. So it allows us to therefore make decisions on the 15-minute where we can be looking at potential scalping opportunities on the 15-minute based even on this 4-hour candle. And a lot of people don't give it the credit when they're on that smaller time frame. So definitely check out things like this. And just another example of how things can look a little bit different. Always be aware that what a daily candle looks like and what the time frames underneath, they will look very different. So this one isn't exactly anything in particular, but you can see how big a difference it can make sometimes over like in here.
So even in this slide, you can see that once the shooting star started to form, probably about this area here, we can see that we got some shorting trading opportunities even in this area because we didn't have to wait for the 4-hour candle to actually form and complete when we're trading a 15-minute chart. What we do know is that the bull action happened in the first 2 hours, but the previous or the consequent bars here, we've got 3 in a row that were very, very heavily sold, which basically retraced nearly 50% of the previous 10 to 15 bars. So straight away, we're looking for a shorting opportunity just in this scalping strategy here. But look, a lot of people may wait for the break and this candle to close. But when you're scalping, you're not generally looking for the bigger time frames to close because sometimes that's where the opportunity is already gone. At this point in time, we could see very clearly in this area that this bar would have been at around this level here. So as much as it didn't look like a shooting star, it was looking like a very unhealthy looking long opportunity. So the pressure was definitely on the short, and these long range negative bars are basically proving that. This is really just a bit of a consolidation. But once this level broke here, once we made a new low, there was definitely a significant area here where we could have benefited from taking the short.
And of course, if we had more information about this chart, we could make some more informed decisions. So let's actually jump straight into the charts and go over a favorite of quite a few people recently, which has been the US dollar yen. So we'll bring that one up just quickly. And I was talking to Tyrone about this just about 10 minutes ago, and we were talking about the multiple opportunities that we've seen here on the US dollar yen. So traditionally, a lot of people are going to come into a chart, they're going to look at it like this, and they're going to say, okay, I see some stuff. They're not necessarily going to draw this kind of line. They're just going to see it's a bullish market now. But when we were back down in this zone here, what kind of decisions could we have been making? So when we switch this over to a line chart, what a few people may recognize is this is actually an inverse head and shoulders pattern. So you'll notice here, we've got the left shoulder, the head, and then the right shoulder. Now this is on a 4-hour. I do know that that is not necessarily a scalping time frame, but what you'll see is when it does break past kind of this intervening like neckline area here, see how aggressive the market is and see how it's angling up, and you can see it's constantly making higher highs and higher lows. When it breaks zones like this, as scalping traders, we can be there to at least get the initial move. So if we're here on a 4-hour and we're looking at something like this on the 4-hour, we can possibly go down into the smaller time frames, switch to our candle charts, possibly even go down to a 15-minute chart, and we can look for the break points when the market breaks. So see here how when it does finally break through here and it closes that 15-minute, that then has a very quick move of around 30 pips. So if we were placing a trade like this in a scalping session, we would potentially be putting a buy order here, placing our stop below here, which is around 30 pips, and we could quite easily pick up a one-to-one type of trade, which is often what you find in scalping. But because we've done the analysis on the bigger, longer time frame, we know that there should be a lot more in this trade. In fact, with head and shoulders patterns, what we should be looking for is around the head to the neckline. So that actually should be where the entire trade ends up, somewhere around up here. So if we take a conservative type of take profit and even say, okay, if we place this trade we buy it here, we place that really tight stop loss, we could very easily be looking at potentially a 3 or 4 to 1 scalping opportunity. And these can be very profitable. If you put 1% trade risk on this, of course, you're making a 3 or 4 to 1, you're making 3 to 4%. That's pretty serious.
So it's pretty important when we talk about having multi-time frame confirmation. This is exactly the point. We've got an inverse head and shoulders on the 4-hour chart. So once that is broken, we're very comfortable that the USD yen is going long. So any opportunities that we're taking, we're not really looking for one-to-ones at this point. One-to-one trades generally appear in range-bound sideways markets where you're really bouncing from one support to a resistance zone. And generally, you are going to get that one-to-one sort of movement because there's no real power in the market. But a broken inverse head and shoulders to the upside on a 4-hour chart does mean a significant amount of pips on a 15-minute chart. So every trading opportunity you can get long, and that could be a break of a new high or just a series of higher lows and higher highs on a 15-minute chart or even a 1-hour chart. Most of those are going to carry forward a lot more than traditionally they would in a normal scalping strategy. So you basically, when you can confirm a pattern that has broken, it will make a very, very big difference to the power of the trade when you enter it. And also it's going to affect your risk reward ratios in a very positive way.
Other things that are really good about this type of scalping method as well is because when you're talking about a 4-hour, you can always back and refer to that. So if we're in a scalping session, let's say we've said, okay, we want a 2 to 1 out of this, which is totally fine. So we're putting a 30 pip stop loss on to potentially get a 60 pip take profit. When you see the 4-hour close and it closes like this is a very clear break. Okay. All of the big traders are going to be seeing this on the bigger timeframes as well. And look at the aggression that happens in that next bar. That's some pretty serious movement. And that is where you can get the confidence to stay in your scalp. You've made the bigger, longer term analysis. You've gotten in on the smaller time frame. You've gone for a bigger risk reward scalp, and you've got the confirmation on the 4-hour that it has broken and it has closed. So let's say you took off potentially half of your order at the 1 to 1 and you left the rest of the order on for a 4 to 1. So if you took a 30 pip stop loss, you took the first half off on 30 pips take profit, and then you took the rest off on let's say 120 or 150 pip take profit, you would have got both and you'd have a very successful trade overall. Plus your psychology would have remained intact. It's not like you would have been sitting there stressing about the market. Already half of your order is off, half of your order could be broken even, and the other half could be left on for the bigger, I guess, prize. And that's really cool thing about trading. You can manage it like a business, you can manage it differently and have some success. So this is a really good opportunity. I love this one, the US dollar yen, definitely a big success.
Absolutely. And look, when you bring in risk management into any scalping strategy, like Thomas has suggested, taking half of your order off at the 1 to 1 and breaking even the rest of it, what it does teach you to do, especially for traders who are first starting out, is having confidence that the market is going to do what you expect it to do without you having to stress about it. It is very important. Cutting trades short all the time is not going to net you a very good return in the long run because you're never going to have the confidence to let a trade play out. Now, no one can determine when a trade is actually going to stop. Nothing's to say that the yen couldn't go to 118. So I'm not saying that you're going to get 1,800 pips in one trade, but not by any stretch of the imagination. But no one can really determine where it's going to stop. That the influence of how currency works has many determining factors. Currency, country versus countries, economies. There are a lot of things. There are a lot of moving parts that make a currency move. All we can work with is the information that is in front of us. So what you're ideally looking for, especially when you are scalping, but you're scalping and you're taking your risk off, is the first serious point of resistance in front of you in this particular instance. So, and that may be 150 to 200 pips away.
If we actually went and had a look at this on the larger time frame, even higher, what we would have noticed as well, if we put this to a line chart, is there's quite a lot of support that's going to be found here and therefore resistance. So if we were taking this break and the break was here, we know that there's probably at least 100 pips of movement before it's going to find potentially any form of resistance. This is a very clear zone for a lot of people out there. So there is, and that's why the market did move very quickly to that point. You can see it gravitated to there very quickly. So whenever you're looking at scalping, always check those bigger time frames. they're really powerful. Another thing I want to bring up, because we're seeing it right now, is Tyron and I were talking about this, and a few people out there probably know this pattern. But what's cool about this is, again, we're on the 4 hour. Again, we've seen this long move that's happened. But if anyone out there knows what this is, chuck it in the chat right now. It's a flag pattern. So we're seeing a flag appearing here. And on the line chart, this is very nice and clear. Tyrone, talk about why the line chart's cool with flags.
Yeah, well, look, this is a really good example as to why you should use line charts and bar charts or candle charts to actually do your analysis. Because if we take this back to a candle chart, the flag is nowhere near as prominent. So you could easily look at that and say, well, it doesn't really look like anything. But when you take your analysis back to a line chart, you can see very clearly that the highs and the lows of this flag that are forming are making a very clear flag. So in hindsight, you could say that's a very clear flag on a line chart. You take it to a candle or a bar chart, and it just looks like a little bit of consolidation. Okay, but consolidation that forms inside of a flag is always going to be stronger than consolidation in a sideways market. So if you're able to identify that this is a flag pattern, you can basically trade it like it's going to go for a flag pattern take profit arrangement. So again, we can take this back to a 15-minute chart, and we can start looking for any long opportunities. Let's bring that right forward. We can start looking for any long opportunities that present themselves on a 15-minute chart with a take profit of what the 4-hour flag would potentially produce.
So do you want to, let's go through it. What have we got here? We've got a very clear break at the top here, yeah?
Absolutely.
Yeah. So if we're seeing the break happen on that 15-minute chart, go back to the candle. Let's say we see an actual close around this point here. What we're probably going to see is some explosive move, at least initially. And a lot of scalpers out there, all they're looking for is explosive moves. Sometimes it can be 10, 15 pips. That's what they're looking for because their stops are that tight. So when actually markets do break to new levels, especially when you're looking at the bigger time frames, they move quickly, and it moves 10, 20, 30 pips very, very quickly. So if you get into these kind of positions, you're going with the trend, at least on the 4 hour, the 1 hour, the 15, you're going in the direction, you see the bigger picture, and you can place tight stop losses down here, down below even the last swings, and take those breaks, and they can be quite successful for you. So this is a really good example. And what Tyron was talking about, do you want to draw that one up, Tyron? What were you talking about in terms of the length that we might be able to get out of this trade?
Okay, so the length that we want on this flag is ideally 80% of the move from the initial break of the resistance, which is roughly up there to the top of the flag. And we can replicate that and take that from the break. Okay, so basically that distance there is the classic take profit for a flag pattern. Okay, but we always like to take an 80% rule where the majority of our profit will be taken off at around the 80% mark.
Somewhere around here.
Somewhere around, yeah, probably about around that area there. But as you can see, even at the top of this pattern, even if this fulfills its potential all the way to this area, you can see this going smack bang into the first place that it's going to find resistance, okay, which is this place here, which is support for a little while. This is definitely going to find a form of resistance when it reaches this area. How strong that resistance will be will depend on other factors because that is a reasonable move away. It's still a couple of hundred pips away. But one thing's for certain, it will take an almighty move to break that resistance without having a reasonable pause. You don't want to get caught up in that pause, especially when you're scalping, okay? So the thing is, when you're taking profit and you're looking at stop losses for scalping, it's no different to normal trading. You've got to think of it like this. When you're looking at setting a take profit, you want as little as possible in front of you that could cause you any issues. But on the flip side, when you've got your stop loss in place, you want as many obstacles as possible between where your entry point is and when your stop loss will be. Because ideally, we want protection for our stop loss. So the more obstacles there are in the way, and by obstacles, I'm talking about things like, you know, a support line that needs to be broken to get hit, potentially some moving averages that price is left behind now. All those sorts of things are going to stop price from falling or at least halt it and protect your stop loss to a certain extent. What we don't want is those things in front of us. We don't want resistance in front of us. We don't want moving average or important moving averages in front of us because they are going to cause us grief. Okay, so
we're definitely not going to have those in this trade because it's breaking to a new high.
No, That's exactly right, because this is what this trade has done. Now that it's moved out so quickly, it's put all of the important moving averages, at least in the interim, behind where price would be. So it should be clear sailing for a fair portion of this trade.
Cool thing about this as well, and why I wanted to bring up the 15-minute as the trading opportunity, is what do we see about this 15-minute? Where do we see the candle closes? A lot of people don't look at candles, don't look at closes. Look at this. Every time that the price has gotten past this point, has the 15-minute closed above? It has not. Look at this. We go back through time. No 15-minute closes above this point. So really the clear 15-minute break is somewhere around at this point here. Obviously past then it goes. But when this happens, this is our go signal on this trade. And the reason this is our go signal is these ones, if we looked back in time and we said, well, does that look the same anymore? I'm sure we've all had that feeling. You go back in time, you look at your trade, you go, I don't know why I was in that. I can't remember why. Because once the candle is closed, it's locked in time and nothing can take that away from the charts. So do remember, you're looking for something where you can go back in a month's time, you can be doing your review of your trades and you see, I know why I took that trade. I waited for the confirmation. So this is your confirmation go signal. If you were being a scalper here, you'd be looking at the last swing. We'd probably have to even jump down into the dreaded 5-minute here just to see that swing. I think the price was about here. So our swing would have been probably around here. So you're talking about a 10 pip stop loss. This is scalping. Sometimes it can be like this. And of course, it's already gone over 10 pips. So we could be looking at, already a 1-to-1 trade or better, but we have a bigger plan. So this could be a serious trade if you left it on and it did have the success.
As much as we don't advocate trading on the 5-minute chart,
I do not do that.
We do not do that. If you do go back to the 5-minute chart after carrying out 1 hour, 4 hour, and 15-minute analysis, you can see very clearly all of the different opportunities to actually go long on this trade. You've got a beautiful series of higher highs and higher lows here. So if you're looking for an entry on a 15-minute and you do get a little bit confused, drop back to the 5-minute and you probably will get an entry point just on a break of a new high. Any of these zones being taken out is a signal that you can definitely go. Okay, so don't do your analysis ever on a 5-minute chart, but if you're looking for an entry point or an entry trigger, if you like, for a 15-minute trade, you can sometimes get a very clear signal on a 5-minute with breaks of highs and lows.
All right, I think we've talked about enough about the US dollar yen. So let's jump onto another favorite, which is the Australian dollar. 1 second, just jump over there now. So again, we approach the Australian dollar. A lot of people are talking about this, had a few phone calls this week with people. Seems to be the thing that everyone's seeing, but a lot of people aren't trading correctly, which is interesting. So here's the Australian dollar. Here's its trend over time. What do we notice about this particular currency right now? Well, that's a trend line that has been, what's happened to it, Taro?
Well, that has definitely well and truly been smashed.
Been smashed. The technical term for when trend lines get broken.
The technical term for when trend lines get broken.
Yeah, so it's been smashed, and it has been, obviously the close has happened. There's no real question whether the close has happened now. It definitely has, and on all of the time frames that you're looking at, you will see that close. So as scalpers, we're recognizing daily what's happening with the trend. Looks like it's down. So let's jump onto the other charts and start to think about how can we trade this in a scalping mindset? What can we do? So we're on the 4 hour. Okay, cool. It's making a series of new lows. That's good. Let's jump onto the hour though and start to think, well, can we scalp potentially the hour here or 15-minute? Let's bring in some other indicators potentially and start thinking about what we're doing. We know that the trend's down. We've got our bias. Now let's get involved. So what are we going to do, Ty?
I think a good start will be putting some stochastics on.
Let's throw on one of the favorite stochastics. So straight away with stochastics in trend, what are we looking for if we're looking for a bearish trend?
Okay, so I know a lot of people out there are probably thinking, hang on a minute, stochastics is actually a sideways trading indicator that you use and you don't use that in trends. In a scalping set, you can actually use a stochastic oscillator, and it is actually a very good help when you are using it to scalp, but only in the direction of the trend that you have identified. Okay, so in traditional use of the stochastic oscillator in a sideways market, you will buy when it's oversold and you will sell when it's overbought. Okay, very simple strategy. People employ it very easily inside of channels. But when you've identified a broken trend line and you definitely have a bias one way or the other, in this case on the short side, we will never ever long an oversold stochastic in the direction. We have to only take the overbought signals, because you're getting the power of the trend, and all you're doing is really getting a bit of a retrace in what is effectively a solid downtrend now. Okay, so if we look at these examples, we know clearly that we're in a downtrend. We're on the 1 hour chart now. We've seen the daily and the 4 hour. We're very comfortable that we're going down. As you can see, as the stochastic goes up above the 80, I don't even mind bringing this down to around the 75 or 70 sometimes in a very strong trend, because sometimes the trend can be so strong that the stochastic doesn't even get back up to the 80 in an overbought zone. So don't feel too afraid to move that down. But in this case, we'll keep it simple, and we'll leave it at the 80. You can see that every time price has gone, price has retraced up a little bit. So it's had a bit of a pullback on the downtrend. When it has gone above the 80, we can see it there. We've had a solid pull down. It's done it again here. You can see the retrace in price, which has forced the stochastic to go overboard again. And it's done it again here. You can see the retrace. All fantastic entry points to actually join this existing downtrend. Okay, and we already know that we're in a downtrend. We've seen that on 2 time frames. So we're only looking for short opportunities here until we're given evidence to the contrary. These are the ones that you never take in a downtrend. You never ever count a trend, a downtrend, especially when you're trying to scalp.
Yeah. It's bad. It's bad, guys. We could talk from first-hand experience there, and we've seen a lot of people come unstuck on those kind of things. So do not count a trend when you know there is a prevailing trend. It's getting too greedy. Take the easy pips, not the hard pips.
And there's just no reason to, because there's so many trading opportunities. Now, the other thing, even though we haven't actually briefed it, the other thing that people may be thinking is, well, is there a reason why the Aussie is being shorted so heavily? Well, you know, it's probably for the same reason that the USD yen is going up. Like the USD yen is going up with the power of the demons, which is actually forcing the correlated pairs, basically everything against the US dollar down. So yeah, the Aussie is being bolstered, the Aussie short is being bolstered by the USD strength. So always, never be afraid to look at the different time frames and the different cross pairs and say, well, what's one doing versus the other? Okay, so you would automatically assume that the euro and the pound USD are also shorting. So what we're looking for, not basically shorting every single thing that's against the US dollar, we're looking for the ones that are the most clear.
Yes.
And at the moment, the Aussie is the clearest short. Okay, so it's the one that's feeling the real heat against the US dollar compared to the pound and compared to the euro. It doesn't mean there's no opportunities in those, but the Aussie is the one we want to trade short because it's the one that's showing the most weakness.
And what do we see here, Ty? This. We're not looking out over the horizon. So over here, what do we see? This is US dollar index.
Okay, this is the US dollar index.
Yep. So basically what we're seeing here is we're seeing consolidation on the US dollar index, followed by a break of that consolidation to the upside. So this is US dollar strength happening on the index. And that directly correlates with what we're seeing happening on the markets. We're seeing the Aussie break at the same time that the US dollar index is becoming stronger, which means strong US dollar, weak Australian. And we're also seeing the US dollar yen breaking to a new high as well after the US dollar index breaks out.
And for those who don't trade the US dollar index often, and I'm actually one of them, can we break this down to a smaller time frame? And let's just see if we can identify any long patterns on this particular. It's just I've noticed there that.
Do you want line?
Let's take it down. What are we in with the
4
4
hour
at the moment? Can we take that down one more time frame?
There's our 1 hour.
Okay, so we can see clearly here on the 1 hour, we've got our line break. You can see that the price has come back and retested this level, which is always a very good sign that when a resistance line has been broken, quite often price will break it aggressively and come back and retest it. Okay, that's what we call a role reversal situation.
I was going to say, does anyone know what that is? Yeah.
Sorry, I should have asked. That's a role reversal. Okay, so that is resistance becoming support. Okay, so if we miss the initial break, which we may well have, because sometimes the candle, we don't encourage trading a candle before it closes on the first break, just to make sure it's not a false breakout. Sometimes they can be very aggressive on the long, but when we get an opportunity that price does come back and retest this zone, it doesn't mean that this zone is going to not hold any longer. In fact, this zone now has become a support zone on the back of the resistance that was there previously. So in actual fact, it's actually made it even stronger. Okay, so don't ever be afraid to enter a long position on a retest of a resistance zone once it's broken, because you have got extra, basically support there from the previous resistance. We call that role reversal. And we can see clearly here on the 1 hour that we're getting very clear higher highs and higher lows, plenty of opportunities to basically join this trend. And this, the US dollar index is as easy to trade as any currency pair. So
it is, though what I would suggest is that we generally use the US dollar index as a basis for us to potentially get more bias on our other trades. And when we see something like this happening, we know the US dollar has been incredibly weak over the last couple of, almost the last year. I mean, look at that over time. But you break this out even out to a weekly, and I know we're scalping tonight. I know we're scalping, but check this out. Look at this level. Resistances, found support, found a base, broke through. That's incredibly serious. So we then break that down to the other time frames, get into that scalping mentality, and we can get on board these trends, scalp them, make the profit that we want to make, be in and out quickly, which is probably what most people are here for tonight. And you don't have to be sitting in there for weeks. You can be sitting there for hours. So you can do this during the session. So it's not always going to be on like this, but when you're in trends, when you're seeing these things happen, when you're getting involved with things like the Australian US dollar and US dollar yen and other currencies that are all doing very similar things, you can see the trends are working, these systems are working. So just always check that stuff out. Bringing in some basic indicators like the stochastic can definitely work out for you. So we'll just quickly jump back into some slides. Let's talk about another thing. So let's talk about channeling on range-bound markets. So of course, we're talking about trending markets right now because I think we're seeing trend. I think Tyron would agree we're in a bit of a trending market, but there is also channeling range-bound markets. So we'll jump into the chart in a second, but when we're building a strategy for scalping, we need to consider what is actually happening in the market. Is it trending or is it range-bound? Once we've made that decision, whether it's trending or range-bound, these are just some of the things that we can be looking for to build a system. So we always talk about building a system. We always talk about giving it a business-like approach, which means you need to give it points-based approach. And these are some of the indicators, patterns, things that we like to use. So when we talk about pattern analysis, double bottoms, head and shoulders, channels, flags, pennants, those kind of things, the really slightly less subjective patterns that you can get your head around. There are other ones, but they become a little bit too much difficulty, I guess.
Building a strategy is like building a case. And when you are using all of these different forms of analysis, like support and resistance and pattern analysis and indicators, you're basically making sure that you've got a multi-dimensional approach on how you are looking at the bigger picture. A lot of people, look at a lot of traders, I'll be honest with you, one of their biggest failings is they don't actually look at the market and see what everybody else is seeing. They're only seeing what they are seeing. And that's because they're not applying, a different approach to what someone else could be doing. So the more things that you've got in your favor, the more chance you've got that other traders are seeing the same thing and they're going to trade in the same direction as you. Okay, so applying all of these different filters. Now, not all of them are going to always be there, and that's why there's so many of them. Okay, so ideally, sometimes in a perfect world, when they're all there, that's when trade actually fails, ironically. So all we're looking for is ideally, some points out of each group. So if we can get, a pattern, that's just great. If we can get support and resistance, it's always very, very important. If we can get one or two indicators to help confirm what we're looking at, that's a 3-phase basically approach. And finally, a candle confirmation in and around the time frames that we're operating in is really just the final, nail in the coffin of the trade that's going to happen. Hopefully not a coffin. Hopefully we're going to be.
I just want to add one of the other indicators quickly here, which is Bollinger Bands. And I want to talk because a lot of people are going to say, oh, that's very good, but how are we going to get into these trades? So we've got to be honest with ourselves when we look back in the history, even if we were looking at it normally. And we can see here that the Bollinger Band is broken at this point, which is very similar to when the stochastic goes into the overbought area. And what we also know at this point is that the market on the last swing reached this point here as its pullback. So where do we think our stop loss has to be? Our stop loss is going to have to be at least a few pips behind here. So when we enter this trade, we're going to need at least 20 pips, and we're most likely going to get in around this point. But what happens with the market? The market holds. it doesn't go back and hit our stop loss, and it comes through and gives us the goods. And if we stayed in this position right now, we'd be up 56 pips, wouldn't be in there for too long. We would have definitely had 40 pips fairly quickly, which is nice. And that's a 2-to-1. You could already be out of this trade if you wanted to be.
And just even on this example, I know we touched on it a little bit before, but adding the Bollinger Bands to it is just giving us a bonanza of confirmation that this is going to go short. Like we talked about those two stochastic overbought levels earlier, and you can see how they sold off when they did cross above the 80. But what we've got down here, which is even more compelling, is that we've got the overbought sold being breached again with a cross happening over it. But what we can also see is the Bollinger Band's middle band proving a very significant resistance for this little peak. We get the big indecision candle, the big doji candle here that we're looking for a market that is starting to weaken. Buyers are certainly losing their momentum. The sellers are probably taking control. We've got our two indicators being the Bollinger Band and the stochastic oscillator confirming that, this is more than likely going to go short. But the most important of all, of course, is that we're in a downtrend.
And we're also in a downtrend where it has broken to a new low. The new low is already absolutely confirmed here, and it's retesting that break. So what better place to get involved? And I just jumped into the 15-minute to have a look there, but you're really, what better place to get involved? Now, I think last time we talked in the first scalping strategy, we talked a little bit about range-bound markets, so we probably don't have time to go through that today, but it is in that video if you want to go check. And this is just what we're seeing right now. This is just pure trading, really. It's cool stuff.
Yeah. Now, I know a lot of people are probably wondering, it all looks fine in hindsight, and it could be hard to get into, but really pay attention to the stochastics, the Bollinger Bands, and the candle signals that you're getting on the smaller time frames, because they're the ones that are giving you the here and the now of what price is doing. So that doji example that I showed you on the 1 hour, if we can just go back to that for a second, that's a very clear signal on that 1 hour candle that, right here we go, right here, we are short. Okay, there is no question. We're not shorting on this candle, this candle, or this candle. We are well and truly short when this candle opens, because we've got enough confirmation that the market is weak. The power is with the sellers here, so there's no reason to hesitate. Okay, so look out for these candles at interesting points in the market where they're at a serious point of resistance or support for a long, because they're the ones that you're going to give you your entry point.
And remember, a long leg doji like this, it's not good by itself, but it is more powerful when we're bringing together the case.
That's 100% correct. A long-legged doji is useless in the middle of nowhere, but when it's sitting in the middle of a Bollinger Band, feeling resistance and feeling heat from overbought stochastics and a significant downtrend, it's just fantastic. Okay, so Now, as we can see here, the stochastics has crossed down below the 20 and is definitely oversold. Are we going to buy? Absolutely not.
No, definitely not. Okay, well, we'll take it over to questions in a minute. So just make sure that you put in your questions if you have some. We'll grab some of those. But we will just bring up the risk management again. Risk percentages, can't slam this home as much as possible. 1 to 2% maximum, do not basket trade. So the reason why we chose the odd and the US dollar yen to look at tonight is it's just what we were seeing. We thought there were some good technical setups. We thought they had some cool technical analysis that we could do, and we liked them better than maybe the euro and the pound. So if we were trading 2 US dollar strength pairs like we are, we shouldn't be trading 5 of them, because if we are and we're doing 1% risk on each one, we're actually risking around 5%, because if one works, they'll all work probably, and if one doesn't work, they probably all won't work.
And that was my point before about saying that although the US dollar strength will be weakening the euro, the pound, and the Aussie, we chose the Aussie because it was the weakest and it had the best patterns for the short setup. And that's why we're not placing 1% and 2% trades on all 3 of them, because we would expect that they would all fall. Okay, We're picking, I don't advocate being a bully, but when the market, when you're trading the market, you want to be a bully. You want to be a bully on the weakest currency pair. Okay, the Aussie is feeling the heat at the moment. It's the weakest. That's the one we're going to pick on. And you need to be.
Unfortunately, the cold hard truth is that you're making money in the market, someone's probably losing that money. So you've got to unfortunately bully that trade out.
Don't be afraid to be a bully in the market.
Yeah, and of course follow your built-in strategy, just like any business. So Fabian, do we have any questions from tonight? Let's go over some questions.
Yeah, we've got a few questions. So going back to the US dollar Japanese yen trades that we were looking at, one of the clients mentioned that the 200 EMA on the daily was, I believe it was broken or it was about to get hit. Is that something that you could take into consideration on that trade?
Yeah, cool. So I assume they're talking about on the daily. So let's just
That's right.
let's just add that 200. Probably got it already here. Yeah. Okay, cool. Yes, you definitely would take that into consideration. 200 is a serious moving average everywhere. In fact, when this market, if it does break the 200 and it breaks above and comes down and keeps going, that actually is a significant change of trend for people like Goldman Sachs, people like JP Morgan, those kind of guys. So yes, that would be a big part of what I'd be looking at. What will be interesting is if we took that length again and we broke this down just quickly and we said, okay, this is the length that we're going for. Yeah. So what it does is it does say that it's going to shoot through it, but we're scalping. So if I was scalping this, I would absolutely be looking at this would be the first point that I would have some issues with, and the market's confirming that by it being a swing over here. So yeah, if I was scalping, I'd definitely be a bit concerned about this level. But remember, we're getting in with a 15 pip, stop potentially, and
70 pip trade
70
before it even gets there.
Yeah. So, but yeah, very good point. We love the 200. Always have the 200 on your daily.
Okay, and
Hopefully.
that's the exponential or simple moving average, just to double check?
Exponential, simple. What do you think about that one, Tyrone?
Look, when it comes to the 200, we like to stick to the simple moving average because it's just a little bit more steady and a little bit more consistent. When you're using moving averages to actually have a scalping signal like a moving average crossover or price closing dynamic moving average, that's when we find that the exponentials work a little bit better. So what our general rule of thumb is we use 4 moving averages. We use the 10, the 5, the 20, the 200, and for longer term trades, we use the 50. Okay, so you can, for short scalping, the 5 and the 10 and the 20, we use exponential. And for the 50 and the 200, we use simple moving average, just simply because that's what most people look at, and they're so long, and the longer term time frames that we're looking at with those just make it a little bit steadier. But certainly for scalping, if you're using moving average crossovers, maybe you're crossing a 5 and a 10, or potentially a 10 and a 20, exponentials for those type of moving averages are far better because they're far more reactive to what price is actually doing.
Perfect. Any other questions there, Fabe?
Yeah, thanks, guys. Another one around scalping news events. What are your thoughts on that?
Scalping news events, something I know well. Look, it depends what the kind of news event is. The one thing about news events is it is a bit more, I guess, coin flipping. You don't know what's going to happen necessarily. So I don't like it because it ruins your statistics. One thing I will say, stay away from non-farm payrolls. Non-farm payrolls is terrible. It's incredibly difficult data for the market to interpret correctly. So you'll see a lot of whipsawing, and very infrequently will it run in one direction and not come back and whipsaw and do all these other things.
And the problem is with news scalping is it actually really affects your risk management, because ideally when you're scalping, you're having fairly tight stop losses in place. And that's nearly impossible to do in a news event because, like I said, and like Thomas said, the whipsawing effect prior to the news, actually the whipsawing's worse before the news is released.
Yeah.
And yeah, the whipsawing will often take tight stop losses out. And yeah, quite often it will go in your direction straight after the minute it's taken you out. So it really messes with the risk management side of things.
And things like, Pepperstone is very tight on its spreads, but still there are times where, the market will react crazily and it may jump up and down, and that was real price, and it jumps up and down 5-10 pips. When we're scalping, we only have a 15 pip stop. It might hit us out, then go the other direction. And a lot of people will have experienced that. Why take that risk on scalping when you can be successful with your technical analysis and pick some great statistics and treat it like a business? So you don't have to, is the answer.
You don't have to do it. Absolutely not.
Yeah, cool. Any other ones there, Fabian? We'll take one more if we've got it.
Yeah, thanks, guys. It's more about, obviously, you've got stochastics, you've got MACD, you've got moving averages. How are traders supposed to determine which settings to use for those indicators?
Yeah, just use the standard ones. Other than moving averages, just use what is in the platform. If you're using MetaTrader 4 or CTrader, just use the standards. They are fine. You do not need to reinvent the book. Do remember, most of the big guys do trade MACD with the standard settings. You can see that if you ever see the reports by the big traders, they just use the standards, guys.
It's always important to remember that an indicator is only as good as the people that are seeing it. So
Yeah.
if you change the numbers around where you're only
Yep.
seeing something that nobody else is seeing, that indicator is almost rendered useless. So
Yeah.
you want to be trading what the other people are seeing.
And we've done a lot of testing with this through robots, expert advisors, that kind of thing. We've got systems. We've then tried to, I guess, refine them by changing it and using ranges. And what you'll find is that at some period of time, that range might be doing better. But over a long haul, if you put a robot out for 10 years, not many of them survive it through, but also you'll find there's no real benefit in changing those numbers up. If it doesn't work with the basic numbers, probably ain't going to work. So I guess that probably ends it for this week. Really like everyone to come out. Thank you very much for coming out. Questions, awesome. So thank you for asking them. And I guess we just also want to let everyone else know, like last week, we had some good signups and stuff. We've got a 101 course. If you're interested in some videos, you can come and just get that for free on our website. And we might sometimes, upload a video or something like that as well, just for free to those guys. So along with these webinars, we do that. But we really appreciate the questions and look forward to doing the next session with everybody.
Thank you, guys. Great presentation, and it'll be available on the Pepperstone website sometime tomorrow afternoon, and you'll also receive a recording of it. So thank you, everyone.
Awesome. Thanks, everybody.
Thanks for your night, everybody, and have a great night.
Good trading, everyone.